Well, hello friends and clients. Good to see you again. I'm Jake Mazone, of course, investment advisor and director of retirement portfolio management. I formed this small investment management company after the stock market crash and Great Recession of 2008 and 2009. One of my main goals is to provide existing and new clients with alternatives to traditional stock and bond investments, while protecting them from potential bank failure and portfolio losses. With this series of YouTube broadcasts, I'm committing to my personal goal of providing free advice to clients and friends about surviving bad economic cycles, retiring richer, and taking key investment advantages during specific geopolitical developments. Although most of what I discuss pertains to existing clients, my advice will apply also to prospective clients that may eventually want to take advantage of the unique combination of services and advice that I offer in managing retirement savings accounts. My hope is to enrich the life of any viewer, regardless of a relationship we may or may not have. I've designed this video as a way of gently warning my valued clients of many years and also getting in front of many of you that I do not regularly get a chance to visit with. At the present time, I'm managing over 100 accounts and about 75 households. As a disclaimer, I must admonish you that some of what I discuss may be disturbing for a few of you that are not my clients, and also those that may have been lulled into a state of comfort through years of slow growing wealth and otherwise smooth or even rich lifestyles. As the tension grows in the presentation, you can rest assured that any investments or funds that I manage are designed to withstand very serious market crashes with only mild to moderate impacts. The reason is that I invest my valued clients in holdings and securities that provide a quick recovery back to break even, much to the dismay of others around them that are invested differently. Can you guys bring those mics back a little bit? Oh, anyway, today we'll be covering a period of economic prosperity that ended in late 2007 and the reasons that led to the Great Recession of 2008 and 2009. We're going to discuss the quasi-economic recovery that started in 2010 and see if we can draw any parallels to past economic cycles like the Great Depression of the 30s. That will lead us to present day, where I will reveal a shocking prediction of how I feel the economy will drastically change in 2015 and how that change will begin its reversal before the end of 2024. There has never been a comprehensive presentation of these market crash predictions published in print or video, so I know you'll appreciate the many hours that have gone into preparing this video just for you, my retirement investment clients. If you're not a client and grateful for a presentation that may possibly save you and your family from bankruptcy, I'll put up a slide at the end of this video with my company website and contact information. It's very possible you'll find that I'm your best choice as a financial counselor over your retirement savings, 403b, or 401k. If you're a financial news commentator or stockbroker, you may want to turn this video off now because you might get offended that much of what I discuss is in direct opposition to what you believe to be true or to what you tell viewers or your clients. Lastly, I must share with you that the advice I give in this presentation is in no way a green light for you to buy, sell, or change your investment accounts without speaking directly to a licensed professional like myself. What my deepest hope is for those of you that are not my clients is that as you digest each of the factors presented, it will prompt you to contact me so that we can start talking and planning to heal your accounts that are improperly invested and exposed to the risk of a severe market crash. If you're one of those people that say, I don't need your help, I'm good, or feel that the great U.S. economy can never fail, well, I can sympathize with you and felt the same way leading into the crash of '08. But you really need to carefully review the later section of this video and listen for several reasons why the fall may have already started. Undoubtedly, you'll conclude that a phone call to me is past due. So let's review Economics 201. The elements of a prospering economy are full employment, low inflation, including a slightly weak US dollar, also slowly rising interest rates and slowly rising real estate values, high levels of consumer confidence, moderate consumer savings, and low levels of corporate and consumer debt spending. You couple that with a slow reduction in government spending, that is deficit spending, and equality in foreign trade, that is few trade imbalances where the U.S. imports more goods than they export. Mix this economic stew up and other factors such as productivity improvements in corporate manufacturing, and we have a fairly decent running U.S. economy. Now this leads to better earnings and wage increases, which leads to increased consumer confidence, increased corporate and consumer spending. That leads to a housing value and stock market increasing, and that leads to hiring and full employment. Now let's take a reality check to see where we're really at. What we do have from that list are a slightly better consumer confidence since 2009, housing and stock increases only through artificially induced recovery, and I call that QE, or quantitative easing infinity, or money printing. We also have a moderate hiring because the unemployment rate is about 6.5% now. That's better than 10% back in 2009. But we are still lacking an unemployment level below 6.2%. We have dismal corporate spending right now. Incidentally, corporate treasury departments continue to sit on record levels of cash right now. In a robust economy, corporate America is expanding with new plants and manufacturing facilities, new R&D, and even making changes in technical and manufacturing productivity. We also lack is consumer spending, which remains low in areas of large asset purchases. The 35 and under crowd is actually starting to refuse to buy houses. In my opinion, not a healthy but a fragile economic recovery. Almost anything can trigger a stock and real estate crash again. It can even be a slight increase in lending rates, or what is going on in the Ukraine, or the Israeli-Hamas conflict. The economic fragility has been enhanced by quantitative easing, money printing, or government bond buying. All mean about the same thing. They are monetary policies that weaken the US dollar's value and eventually create inflation. We know that the greatest inflation hedges are considered to be the value of commodities such as gold and oil. The U.S. bond buying, which the Fed is slowly winding down, also drives down long-term interest rates, which real property loves because of its effect on lowering the 30-year fixed rate loans. Throw crude oil into the mix because it's a commodity that follows gold, and you have a stock market rally, and that's exactly what we've seen since mid-2013. But let's make it clear, it doesn't mean we have completely recovered from the Great Recession of 2009 or that we are in an economic expansion phase. Janet Yellen, the chairman of the Fed, has two directives. Number one, full employment, which is unemployment at 6% or less. And number two, low to moderate inflation, usually stated at about 4.1% or less. Therefore, until the Fed sees these improvements take place concurrently, the bond buying or quantitative easing will partially continue and lending rates or interest rates will remain low. That is, we will not have monetary tightening. The problem I see here is a conundrum of epic proportions, because if Yellen achieves her goals and begins to increase interest rates, I'm afraid this will cut off important large expenditures on corporate and consumer levels and trigger our next Great Depression. To continue our class in Economics 201, I'd like to give you an abbreviated version of the causes of the 2008 and 2009 Great Recession, also known as the mortgage meltdown. So starting in late 2007, hundreds of thousands of ARMs, or adjustable rate mortgages, went bad. A big culprit was the triple option or pay option ARM. The most common choice of payment in this 3-payment option loan was the minimum payment. By went bad, I mean as interest rates increased, it caused an increase in the principal balances each month. This eventually forced refinances or refis, but most were impossible. And that reason is because home values dropped. As you know, refis and other loans, of course, use appraised values, so lenders wouldn't allow them. This led to walkaways and bankruptcies. Another mortgage meltdown culprit was that these ARMs were bundled into groups of investments, and the riskiest ones were called CMOs and subprime MBSs, or mortgage-backed securities. The large buyers of CMOs were major corporations, municipalities, and broker-dealers. Again, property values that go down means that these notes were worth less than the secured property. Consumers can walk away, but investors such as broker-dealers are forced to sell at huge losses, further driving down property values and stock prices. You see, after a couple of very large bank failures, to the rescue came Federal Reserve Chairman Ben Bernanke in 2009, who started to implement monetary policy. Incidentally, you may not know that the Fed is a non-government institution consisting of several regional Federal Reserve banks partially owned by international investors. What Bernanke and the Fed did in 2009 and thereafter was that, number one, they dropped interest rates, and that continued 15 to 16 times, sometimes only 1/8 of 1%, and that helped inspire consumers and corporations to spend and expand. He then began trillions of dollars of money printing, also known as QE, or quantitative easing. This money printing is used to buy our own government 20-year treasury bonds. Again, this drives down interest rates lower and also sparks spending and investment. Also, the third thing that the Fed did is that it pays large banks interest on keeping higher reserves in the vault, which are supposed to be used for lending. Unfortunately, that really doesn't work, because what is not in place is something that is called the velocity of money. It's what's lacking when you simply help banks keep higher reserves. The money needs to be lent out to spark velocity. For true success, a combined plan for economic recovery must include both monetary policy, i.e. the Fed, plus fiscal policy, or congressional policy. Many more laws through congressional policy are needed to stimulate Congress, and they are needed to be passed soon. What we have, which I feel are not the best choices, are, so far in 2010, hundreds of billions of dollars of infrastructure loans were passed by the Obama administration to build bridges, roads, electrical, and sewer lines. From 2010 to 2013, what we had were several extensions to unemployment benefits. Sadly, we continue to encourage lazy Americans by paying them to stay home. Speaking of unemployment benefits, I'll always share with you that the unemployment numbers reported are far from correct. They are only current filers, and there's no accounting for discouraged workers that have given up looking for work. They also do not account for those that have ran out of benefits. They also do not include the underemployed. For example, those that have gone from a $70,000 a year job to a $35,000 a year job. Incidentally, most new jobs in the recovery are underemployment, and many of those are individuals that were forced to switch from full-time to part-time. Some may say we've become a nation of burger flippers. I estimate the actual true national unemployment rate right now is 16 to 17% and not the reported 6.4%. Viewers must understand that the current economic recovery is 100% fake. Yes, while many people may claim we are better off since 2008, the reality is that this recovery has not been driven by permanent increases in productivity, but instead by artificial, temporary government stimulus. First and foremost, money printing, but secondly, trillions of dollars of loan stimulus. To understand just how closely correlated the stock market rise and money printing have been over the past few years, look at a comparison between the growth in the monetary base, or cash in circulation, and the growth in the S&P 500 on any website, 2009 to present day. They almost mimic each other. If money printing is working to boost the stock market, why should I, as your financial counselor, be questioning it? It's because money printing always leads to inflation, and inflation kills a supposed economic recovery, partly due to the problems with rising interest rates. Printing more money via our Federal Reserve to buy our own treasury bonds instead of real investors buying is the catalyst for this fake recovery. I wish I could say it differently and that we are truly recovered from the Great Recession, but we are not. Sadly, the media seems to have announced this blatant lie since late 2010. While many people and investors seem to cheer every little positive sign of growth in the economy and ignore or downplay the negative news, what's really astonishing is how little growth in the economy we've seen in spite of all the government intervention. If the recovery is real, why are stock prices growing faster than corporate earnings? That shouldn't be. This is also evidenced by an abnormally high price to earnings, or PE ratios, of most stock investments right now. A big reason for the stock market's record numbers recently is investors' outlandish expectation of future earnings. It's all smoke and mirrors without real contracts and productivity to back it up. Earnings growth is actually poor. S&P 500 revenues only grew 1 to 2% for most of 2013, and about the same this year. This is no surprise given the US GDP growth was only 2% for 2013. Despite this, the market is apparently expecting an enormous jump in revenues. It's this confusing expectation and its associated media hype that has driven stock prices thus far in 2014. I'd like to now discuss the many commonalities of the Great Depression to modern day markets. Just before the major crash in late 1929, there was a moderate one earlier in the year. It was reversed by an advance of $25 million to stock traders by National City Bank, which is now known as Citibank. The move was praised at the time, but just fueled more rampant speculation and led to an even bigger crash later. Sound familiar to the money printing and bank bailout too big to fail mentality of today, or the drop in stock markets that started in late July of this year? Like today, many investors in late 1929 paid no attention to a company's real value, its assets, and its earnings, but only saw stocks as pieces of paper, today they're electronic pieces of paper, that went up or down in price. Most folks just followed the trend. So when the big crash hit in October of 1929, few people were troubled when the market moguls colluded to try to push prices back up. No one had a problem with manipulation of this sort because no one had had the experience with these types of consequences, just like no one today in the US has experienced the consequences of massive currency manipulation, i.e. quantitative easing. If it keeps the markets up, it must be a good thing, but it does more harm than good later on. As in 1929, one would have thought the market would slow down under such conditions, but instead it soared to record heights. People had become inclined to think that prosperity was a God-given right, rather than something that had to be earned through hard work. Why should they not think that way? I mean, for much of the 20s, everyone was getting rich in the stock market. Conveniently, all market economists and the news media, of course, at the time shouted to everyone, buy, buy, buy. This is exactly the distorted reality today and a perfect fit compared to what commentators and stock market analysts are saying. Okay, in 1921, the stock market was heavily manipulated, as I just shared. It was done in many ways, but one was when major corporate share owners would sell large portions of their shares to drive down the price, only to wait until others did the same. They then go back into the market and repurchase holdings 25 cents on the dollar or at a 75% discount. The big repurchase then sparks others to buy again, much to the delight of investors who want to see prices keep rising forever while looking the other way at warning signs. Think about today how investors are jumping into the market because they see their friends making money. Before the big crash of 1929, the market rose fantastically even when the economy was sputtering. Think of what's happened from 2013 until July of this year. I just discussed the parallels of 1929 and today's economy, so now I'd like to get specific and review what were the 5 major causes that created the Great Depression and prolonged it for over 10 years. On top of everything I mentioned previously, such as a smaller crash preceding it, and also market manipulation, here is what happened. Stocks were mostly bought on margin. That means they were financed. That helped lead to the Black Tuesday crash in December of 1929. Then there were runs on the bank that followed, leading to many bank failures. Remaining banks stopped loaning money, which is essential to the economy, and it froze expansion. Then consumers just stopped spending. Again, that's an essential element for a good economy, and that led to massive layoffs and 25% unemployment. Lastly, the government prolonged the Great Depression by greatly increasing import taxes, thus killing international trade. The recovery actually began in earnest in 1942 after the December 7th, 1941 bombing of Pearl Harbor. What followed was massive spending by the U.S. to manufacture weapons and related items. Hiring of personnel was intense. Real economic recovery was well underway by the end of the war, or by around 1945. The golden age started for this economy, and also did the baby boom. Okay, well, now it's time to get a little serious. Now that we've discussed the old Great Depression of the 30s, I'm obligated to inform you of the new one coming in 2015. This is how I see things coming to a head very soon, and I'd like to be clear that all phases are worldwide occurrences. A quasi-depression will begin in late 2014 or early 2015. The first phase lasts 3 years and is characterized by the following: a 25 to 30% crash in all stock markets, unemployment in excess of 25%. This is based on how I look at the numbers that I previously discussed and not the published rates. I include, remember, current filers, discouraged workers, those whose benefits have ran out, and also the underemployed. Inflation will hit 12% per year as the value of the US dollar falls fast. The more the US dollar crashes, so goes the real estate market further, and also further the stock markets and bond markets will follow suit. Gold goes to $2,800 an ounce. Import prices will skyrocket, leading to much lower profits, and at least 400,000 workers will be laid off. Also, governments will greatly increase income taxes, sales taxes, and property taxes due to a rapidly falling tax base from broke consumers. Municipalities are also forced to drastically cut budgets, including pensions, Social Security, food stamps, and unemployment insurance. There will be about 8,000 fewer national park staff working, and some national parks will be closed entirely. Also, there will be about 40 fewer national weather or storm tracking offices and about a $9 billion cut in cancer or disease research. We will see a drastic rise in the number of juveniles and the 20-something crowd detained for petty thefts and even grand larceny. Okay, now this phase 2, lasts about 2 years. So by 2017, no more money is available for economic stimulus programs and no more funding of overseas war efforts and peacekeeping. China will also refuse to give our country loans to bail us out, which they did during our last Great Recession. Social Security will be eliminated for anyone with assets, including homeowners or even those with income. No more unemployment insurance funding. Food stamps will continue, but will be reduced to those only in dire need. 22% of the U.S. population are on them now, and I estimate that figure will be at about 35 or more percent by then. Also, homeless shelters will replace many apartments or will be rebuilt within the apartment complexes due to the explosion of folks without housing. Shanty towns will start springing up everywhere. By around 2018, Medicaid will be eliminated or combined with Medicare, but services and payments to physicians and providers will be greatly decreased. Many doctors will lose their wealthy lifestyles, and many small hospitals will close their doors due to bankruptcy. Moreover, 1 of every 2 small businesses will go bankrupt during this phase. We will see more and more frequent and stringent audits by the IRS to get tax money from consumers. The lowest tax bracket will jump from 15 to 30% and up to 55 or maybe 60% for those left with moderate to high incomes. Sales and property taxes will double and unemployment hits 40%. Larger factories will avoid strikes by simply shutting down. Small pockets of street violence in major cities will escalate. Think about the past LA riots, and government protests will turn violent. These are harsh words, but there will be a lot of worry and fear going on by late 2018. I predict that murders of family members and business managers will greatly increase, particularly those business managers doing the firing and layoffs. More killings and attacks of lower level municipal and state politicians, but higher level political leaders such as senators will be protected from stepped up security and bodyguards. Politicians will become more reclusive, and no matter what they say, no one will like it. Sound familiar? There will be an enormous anger at any partisan official, but a chaotic government overthrow won't happen, just high office turnover. One of the few areas that will be hiring in years 4 or 5 of the new Great Depression will be bankruptcy lawyers, private security contractors, drinking bars, and state troopers. Inflation will surpass 30% per year, and the US dollar will have dropped by 1/2. Gold will exceed $5,000 an ounce. Okay, phase 3, also lasting about 3 years, will be during years 6 to 8 of the new Great Depression. Few jobs and high bankruptcies will lead to little incentive to pay mortgages. Almost 3/4 of small businesses will close their doors by the end of 2020. Many banks become insolvent and almost no market buyers of foreclosed homes. There will be no runs on the bank, however. There will be major withdrawals such as what Europe and the Middle East has been seeing. Much of the mortgage defaults will be handed over to the government, but they will be stretched so thin that sheriff evictions will be minimal. Because there will be no one to buy the homes of those evicted, squatters will arrive everywhere to occupy vacant homes. Shanty towns explode in size, and homeless shelters will too. Even apartment landlords will find it hard to get a good tenant to replace the bad ones. So the good news is that there will be very low evictions. Also, no more funding for municipal employee pensions in Phase 3. By the end of 2021, those funds are pilfered to pay for the needed services of police and fire. Life insurance companies will not pay out the full value of policies that they carry because their assets depended on stocks, bonds, and real estate performing well. Whole life will be entirely replaced by term life insurance policies. Anyone fortunate enough to find work in years 6 through 9 or Phase 3 will be forced to move down the ladder. 80,000 a year jobs will become 40,000 a year jobs, and no benefits will be given. Up to 60% unemployment at 7 years into this new Great Depression. There will be no shortage of food to give to the poor, however, a small bit of good news, but up to 75% unemployment for those under age 30 or over age 55. Universities and colleges will burst with delusionary applicants thinking more education is the answer, but student loans will dry up. The result is that the cost of education will drop by about a half, or the learning centers will close, or both. Professors, like doctors mentioned earlier, will get a rude awakening in pay adjustments. Some of the businesses that will prosper during years 6 and 9 will be drinking establishments because of many lost souls needing to supposedly drown their troubles in liquor. Also auction houses from all the bankrupt business liquidations and estate sales, and law offices because of all the litigations needed by a broke society to be compensated somehow. Also, inflation surpasses 50% with a commensurate decline in real estate values. Because of no money, few jobs, and no discretionary spending, gourmet restaurants or anything gourmet will be rare. Fast food will do well, but not necessarily prosper. Cheap, high-calorie food will double the obesity problem that we already have in this nation and will cause additional stress from depressed eaters. Speaking of depression, psychological pain and mental illness will go way up during this time. Clinical depression will be very common, up to 25% of the population. The price of gold will pinnacle toward the end of year 9, about $7,000 an ounce. Okay, how about a little good news? After 8 to 10 years of this pain and suffering, the political and economic cycle would begin to turn around. Being that stocks and real estate can be bought at 85 to 90% discount from 2015, there will be a slow, steady growth cycle that will begin with regard to asset value increases. Almost all of this will see its genesis from the few left that are still wealthy and have stepped out of the shadows. One of the first signs will be a slight rise in the value of real estate, followed by a slight increase in jobs created. Although I feel the new depression will be moderately better than the Great Depression of the 20s because our nation is much richer now, the recovery will be very similar to that of the early 40s. It won't look very good in the first few years, but a very profound event. Remember the past example of World War II like a world war, will cause the nation to rally together and cause unity in most aspects of business and finance. I personally feel this rally will come from something we will eventually call World War III, where the US and Great Britain and a few smaller nations will combine forces in order to protect Israel from a massive invasion by several communist nations and Islamic militant groups such as the Al-Qaeda inspired Islamic State of Iraq. Ladies and gentlemen, no matter how you slice it or even try to avoid it, the proverbial writing is on the wall. We will see a major depression, and it is coming soon. However, I never underestimate the government's ability to keep postponing it by last-ditch efforts in fiscal and monetary policy. You know, there is the original story in the Bible regarding the writing on the wall found in the book of Daniel, and it's about King Belshazzar that you might want to digest regarding how he tried to avoid God with a false sense of security through his wine-drinking actions while throwing caution to the wind. It says, they drank wine and praised the gods of gold and silver, bronze and iron, wood and stone. In the same hour, the fingers of a man's hand appeared and wrote opposite the lampstand on the plaster wall of the king's palace. And the king saw that part of the hand that wrote. Then the king's countenance was changed, and his thoughts troubled him, so that the joints of his hips were loosened, and his knees knocked against each other. To wrap things up, if you go back through the presentation and take notes, you realize how important it is for you to understand that you must take care of your family and household in preparing for something very big and fairly soon. For everyone that is not a current client but found this broadcast, I sincerely hope it has helped you to understand the reality of a falsely promoted economic recovery that supposedly started in 2010 and the very real and pending economic crash of 2015 that only a few smart economists are discussing right now. If you are serious about avoiding bankruptcy and maybe even prospering financially during such a crisis, you'll be well advised to watch this video again before you place another dime into savings or another dollar into stock market investments or even a mutual fund. The information I presented here today is priceless, and if you were an intelligent consumer that wants to protect their nest egg, write down my contact information that will soon follow. Skeptics may provide comments directly below the video, but others are invited to select the like icon on YouTube and share it. Please visit the Retirement Portfolio Management website and select the contact page. Also see the final seconds of this video to contact me with further information. Let's organize your retirement plan at work and at home to prepare for the great crash of 2015. Send me an email or give me a call so that we can discuss how you are invested and the steps you need to take for achieving greater peace of mind in your golden years.